In April 2025, the uneasy calm that had settled over global trade was abruptly shattered, sending ripples of uncertainty through financial capitals from New York to Shanghai. For months, investors and policymakers had hoped that the world's two largest economies might find common ground. But those hopes were dashed in a single dramatic move. The United States announced a sweeping increase in tariffs on Chinese goods, raising rates from an already high 54% to a staggering 145%. The White House justified the move as a necessary step for reciprocal fairness, arguing that years of trade imbalances and intellectual property disputes had left them with no other choice. The announcement was met with shock and confusion among American businesses, many of which rely on Chinese imports for their supply chains. Beijing wasted no time in responding. Within hours, Chinese officials convened an emergency press conference, unveiling their own set of retaliatory tariffs. The new measures raised duties on American imports to 125%, effectively slamming the door shut on a wide range of U.S. products, from agricultural goods to high-tech equipment. The message was clear: China would not back down. This marked a decisive and historic shift in the trade relationship between the two superpowers. Both sides now signaled a willingness to endure significant economic pain in pursuit of their strategic goals, even if it meant disrupting global supply chains and risking domestic backlash. The world watched as political leaders on both sides dug in, preparing for a prolonged standoff. China, in particular, began hinting at a near-complete decoupling from key U.S. sectors, accelerating efforts to develop domestic alternatives in technology, energy, and finance. The government rolled out new incentives for local industries, urging them to reduce reliance on American components and expertise. The rhetoric on both sides grew increasingly defiant. Chinese officials publicly dismissed further U.S. tariff threats as a joke in the history of the world economy, while American leaders accused Beijing of economic aggression. Behind closed doors, negotiators struggled to find any common ground, as trust between the two nations reached a new low. The escalation sent shockwaves through global markets. Stock indices tumbled, investors scrambled to reassess risk, and concerns mounted over the stability of what was once considered the world's safest asset, U.S. government debt. The financial world was suddenly on edge, bracing for further volatility. As the trade war entered this dangerous new phase, the world braced for the fallout. Economists warned of a potential global recession, and ordinary people everywhere wondered how this conflict between giants would reshape their daily lives. The next chapter in the U.S.-China trade dispute had begun, and its consequences would be felt far beyond the negotiating table. In a stunning reversal of market norms, investors who would typically rush to the safety of U.S. treasuries during times of uncertainty instead began to flee en masse. The very assets once considered the bedrock of global finance were suddenly being dumped at an unprecedented pace, sending shockwaves through trading floors and financial newsrooms around the world. This mass exodus triggered a historic sell-off, with traders scrambling to offload bonds and a dramatic spike in yields that left even seasoned market veterans stunned. In just 1 week, the 10-year Treasury yield surged by a staggering 0.5%. The largest single-week jump in 5 years, sending a clear signal that something extraordinary was unfolding. Yields on 5- and 30-year bonds also soared, as investors across the maturity spectrum rushed for the exits, amplifying the sense of crisis. The sudden repricing of U.S. government debt sent ripples through global markets, threatening to tighten financial conditions not just in America, but across the world. Borrowing costs for governments, businesses, and households began to rise, putting pressure on economies already grappling with uncertainty. The risk of a broader economic slowdown loomed large, as higher interest rates threatened to choke off investment, consumer spending, and even the fragile recovery in some sectors. What made the timing even more alarming was that this sell-off erupted immediately after a major escalation in tariffs between the U.S. and China. The coincidence fueled rampant speculation that a powerful state actor might be deliberately intervening in the market, using financial weapons in response to trade tensions. Suddenly, all eyes turned to Beijing. Was this a sign of panic from Chinese officials? Or was it a calculated move, a warning shot in a new era of economic warfare, where financial markets become the front lines? The message from the bond market was unmistakable. Confidence in the safety and stability of U.S. debt had been shaken to its very core, raising questions about the future of the world's reserve currency. The world's most important financial asset, the U.S. Treasury bond, had become a battleground, its fate now entangled in the high-stakes rivalry between superpowers. The question on everyone's mind: was China truly behind the chaos? And if so, what would come next in this escalating financial conflict? Rumors swirled that China was dumping its U.S. Treasury holdings in retaliation, weaponizing its status as a top American creditor. Analysts pointed to the timing and overnight trading patterns, matching Asian market hours, as evidence of possible Chinese action. The idea, by destabilizing U.S. financial markets, Beijing could gain leverage in the trade war. This narrative fit the moment. After years of U.S. pressure, China might finally be fighting back with its most potent weapon. If China could inflict pain on U.S. markets, it could shift the balance of power. The sell-off was seen as a warning. China's economic power extends far beyond trade. The world watched, anxious for the next move. The April sell-off was just the latest chapter in China's long-term strategy to reduce its reliance on U.S. debt. This move didn't happen overnight. It's the result of years of careful planning and a growing desire to insulate the Chinese economy from external shocks. As global tensions rise and the world's financial landscape shifts, China is rethinking how it manages its vast reserves, seeking greater security and flexibility. For years, China has steadily sold treasuries, cutting its holding to $759 billion by late 2024, while ramping up gold purchases. This is a dramatic shift from a decade ago, when China was the largest foreign holder of U.S. government debt. Now the country is diversifying its portfolio, buying not just gold, but also other assets considered less vulnerable to political pressure. This shift is about more than diversification. It's a hedge against U.S. sanctions and a move to boost the renminbi's global role. By reducing exposure to the dollar, China is also signaling its ambition to make the yuan a more prominent currency in international trade and finance, challenging the dollar's dominance. Gold offers safety from geopolitical risk, unlike dollar assets vulnerable to U.S. policy. In times of uncertainty, gold is seen as a universal store of value, immune to the decisions of any single government. For China, increasing gold reserves is a way to protect its wealth from sudden policy shifts or sanctions. The trade war only accelerated Beijing's resolve to de-dollarize its reserves. Each round of tariffs and threats underscored the risks of holding too many assets tied to the U.S. financial system. As a result, China has become more determined to chart its own course, reducing vulnerabilities and asserting greater control over its economic future. Whether or not China triggered the sell-off, its direction is clear. Less U.S. debt, more politically neutral assets. The central bank is quietly shifting its strategy, seeking out currencies and investments that are less likely to be affected by diplomatic disputes or economic sanctions. China is methodically reconfiguring its $3 trillion in reserves for a new era. This transformation is not just about numbers on a balance sheet. It's about preparing for a world where economic power is more widely distributed and where financial security means being less dependent on any single country. The world is taking note. Investors, policymakers, and financial markets everywhere are watching China's moves closely, knowing that these decisions could reshape the global economic order for years to come. Not everyone buys the story of Chinese retaliation. U.S. officials argue that dumping treasuries would hurt China too, by strengthening its currency and devaluing its remaining holdings. Analysts note the sell-off hit long-term bonds hardest, suggesting broader investor anxiety, not just a single actor. The financial nuclear option is risky. It could backfire on Beijing as much as Washington. The reality is likely more complex, a mix of market panic, global uncertainty, and some Chinese selling. The Treasury market's turmoil was real, but its origins remain murky. Blaming China alone oversimplifies a tangled web of global finance. China wasn't the only force behind the Treasury rout. Japanese institutions, the largest foreign holders of U.S. debt, were also selling, spooked by U.S. policy volatility. European pension funds rotated out of treasuries, seeking stability elsewhere. Hedge funds unwound risky basis trades, forced to sell bonds as prices fell, amplifying the chaos. Some saw the return of bond vigilantes, private investors punishing U.S. policy missteps by dumping debt. The sell-off was a collective loss of faith, not just a single act of retaliation. The message was unmistakable. Global trust in U.S. financial leadership is eroding. The world's safe haven suddenly looked vulnerable. The events of April 2025 crystallized a crisis of confidence in U.S. assets. Treasuries, once the ultimate safe haven, now looked risky, undermined by domestic policy shocks. Investors are rethinking their exposure to the dollar, wary of its use as a geopolitical tool. Central banks, led by China, are shifting towards gold and other alternatives, signaling a move away from U.S. dominance. The lack of diplomatic resolution only deepens market anxiety. Without trust in U.S. leadership, investors demand higher risk premiums for American assets. The world is preparing for a future where no single currency or market is unassailable. The post-war financial order is no longer taken for granted. The Treasury shock of 2025 will have lasting consequences, regardless of China's direct role. The episode exposed vulnerabilities in the global system and accelerated the push to diversify away from the dollar. Central banks are now more likely to hold euros, yen, renminbi, and gold, chipping away at America's exorbitant privilege. For the U.S., this means higher borrowing costs and less fiscal freedom. The era of limitless cheap debt may be ending, with markets demanding more discipline. The world is moving toward a fragmented, multipolar financial order. U.S. Treasuries are no longer the unshakable bedrock of global finance. Economic interdependence is now a source of risk and a new arena for global power struggles.